Greetings, everybody. Welcome to the weekly economic update here at the Liberty Call. It is Monday, November 21st, 2022. It is Turkey Week. Gobble, gobble, gobble. Hope everyone had a tremendous weekend out there in the interwebs. And if it's your first time watching the show, please give me some thumbs up, likes, shares, subscribes, all that good stuff. I'm sure there's a subscribe button somewhere underneath where I'm pointing. I would greatly appreciate it if you pressed it, and so you get the alerts when I go live, and you can hear about all the fun things that happened in the financial world that day. So anyways, not the greatest day again in the market. See a lot of red across my screen here, and maybe just because it's a short week, but who knows. Anyways, all right, well, let's go ahead and jump in and see how the markets did today. The Dow Jones was down just a little bit, down 0.13%, closed at 33,700. S&P 500 was down 0.39, closed at 3949. NASDAQ was down 1.09%, closed at 11,024. Small caps were down 0.61. The VIX fell another 3.29%, down to 2236. Volatility has slipped a little bit here recently. A little surprising, I think, with everything that's going on in the world, that markets would be falling a little bit faster. But hey, I don't claim to be clairvoyant when it comes to these things. I more or less follow the charts. All right. Canada was basically flat at down 0.02. Brazil was up 0.9. Mexico up 0.41. Let's move over to Europe. Germany was down 0.36. UK down 0.12. France down 0.15. Euro stocks down 0.4. Netherlands down 0.3. Let's see here. Spain, flat. There's no change today. Let's see here. Italy down 1.29%. Switzerland up 0.36. Portugal was flat again, or no change. Let's see here. And let's move a little further down. In the Russian exchanges, they were both down. The MOEX down 1.81. RTSI was down 2.16. Headed over to the Asian markets overnight. Japan was slightly up 0.16%. Australia down 0.17%. New Zealand barely up at 0.04%. Looks like all the Chinese markets were in the red. The Shanghai down 0.39%. The SESE component down 0.41%. China 850 down 1.13%. DJ Shanghai down 0.45%. Hang Seng down 1.87%. And the Taiwan weighted down 0.38%. So like I said, a lot of red across the screen. I mean, there were a few green ones there, here or there, but was not, definitely was not as good as we would like. So, all righty. Well, let's go ahead and read through this week's weekly economic update and see what it has to say. All right, let me make that a little larger. Week on Wall Street, the stock market edged lower last week as it digested a cross-current of conflicting economic data and contrasting comments from Fed officials. The Dow Jones was flat at down 0.01, while the S&P 500 declined 0.69. NASDAQ was down 0.57, and internationals fell 0.88. Stocks slipped. Stocks took a spill after Fed officials' comments cast uncertainty about future rate hikes. You got different, one like James Bullard, I think he's at the St. Louis Fed. He's very hawkish. He wants to keep raising rates. And then you get like Lael Brainerd. She's very dovish. She wants to cut rates down to zero all the time. So you're getting conflicting information. And I think that's probably has a lot to do with what's going on in the market. The more hawkish comments soured investor hopes of an imminent easing of Fed rate hikes, a prospect that helped fuel the market rally the previous week. Concerns over hawkish comments raise investor worries over recession hikes, anxiety exacerbated by weak housing data, and layoff announcements from major technology companies. The economic picture, however, included some encouraging news as retail sales rose and producer price increases moderated. Again, all these people who want to, slash interest rates or at least stop raising them. Do they not realize that would be like, if you're a firefighter, well, you're just tired of, spraying water. So we're just going to, stop now, even though the building's still on fire. We're just going to let that happen. So, I mean, come on, people, pull the head out of your butts. I mean, it's just ridiculous. Producer prices ease. The producer price index reflects the cost paid by domestic producers as seen as an indicator of future consumer prices. It's not typically a market-moving event. That was not the case last week. The October PPI rose a modest 0.2%, well below the 0.4 consensus estimate. The year-over-year increase moderated to 8% compared to 8.4 in September, and the peak of 11.7 in March. The eye-catching element may have been the 0.1% service decline, representing the first decline since November of 2020. Excluding food and energy, the PPI was flat for the month and up 6.7% from a year ago. A final word, we wish you and your family a happy Thanksgiving and express our gratitude for the privilege of working with you. See, I put that there. Well, no, I didn't. My ghostwriter did. Anyways, economic data coming out this week. Just one day on Wednesday, we have durable goods orders, jobless claims, the Purchasing Managers Index composite, new home sales and consumer sentiment, and the FOMC minutes. Companies reporting earnings this week. Today on Monday, we have Dell and Zoom. Tuesday, we have Best Buy, Dollar Tree, Autodesk, and Analog Devices. And Wednesday, we have John Deere. So again, pretty light week, being that it is a holiday week. Most people are probably kicking back with their feet up today. So, pretty slow here. Anyways. All right. Well, let's go ahead and jam through today's market recap, see what it had to say. S&P 500 stumbles as energy stocks pummeled on China COVID concerns. Boy, they're still really worried about that, super sniffle over there in China. The S&P 500 stumbled Monday, led by energy as reports that Beijing returned to economically sapping COVID restrictions, stoked renewed fears about slowing energy demand. I mean, I have to wonder, are they actually really doing any of these things, or is it just they're reporting it just to cause chaos in the news? I don't know. Because here in America, things are going along just fine. I don't know why people are all still freaking out about it. Energy stocks fell more than 1% as COVID-19 lockdowns returned to Beijing after the city reported its first coronavirus deaths in months. Oh my God. Renewing worries about energy demand from the world's top energy importer. Sentiment on oil prices was also weighed down by a jump in the dollar, and reports OPEC and its allies, known as OPEC Plus, is weighing up production boosts of about 500,000 barrels per day at the cartel's upcoming meeting on December 4th. Diamondback Energy, Halliburton, and Marathon Oil were the biggest decliners, as well as energy on the As well as energy, the ongoing pushback from the Federal Reserve members against market expectations for a sooner than rather later pivot on monetary policy tightening continued to keep concerns about a Fed-induced recession front and center. Over the weekend, Atlanta Fed President Raphael Bostic backed further rate hikes, though said he would consider slowing the pace of hikes from 75 basis points, increases delivery in 4 consecutive Fed meetings. About 85% of traders expect the Fed to hike by 50 basis points in December, compared with the prior week estimate of about 80%, according to Investing.com's Fed Rate Monitor tool. A deeper insight into the Fed's thinking on monetary policy is expected in the coming days as the central bankers releases Wednesday the minutes from its October meeting. Quote, FOMC minutes could signal that slower rate hikes don't necessarily mean a lower peak, end quote, Nomura said in a recent note. China-exposed stocks, including Tesla, fell 6%, while Las Vegas Sands, MGM, and Caesars Entertainment led the slump in consumer stocks. While Disney, up 5%, bucked the broader market malaise after reappointing Bob Iger as its chief executive to replace Bob Chapek. In other news, DraftKings tumbled more than 5% after a sports betting company said it was investigating reports of users' accounts being hacked. The move reportedly materialized following internal complaints from senior leadership about Bob Chapek's leadership and fourth quarter earnings that fell well short of estimates, CNBC reported. The broader market stumbled comes during a holiday shortened week with trading volumes likely, quote, to thin out as we approach Thursday, end quote, Janie Montgomery Scott said. Quote, the S&P 500 still shows the early formation of a minor uptrend line off the October lows, end quote. All right. So again, not all bad news. I mean, the world's not going to fall apart today, but certainly not again, we're in kind of a malaise, recession, whatever you want to call it. Just things aren't real good right now. All righty. I have an article here from First Trust, Brian Westbury, their chief economist. It's called The Aftermath Economy. Really good read. So we're going to go and breeze through this. We will forever believe that locking down the economy for COVID-19 was a massive mistake. I wholeheartedly agree with that. There is virtually no evidence that death rates were lowered by government mandates or lockdowns. Business activity in certain sectors would surely have slowed as individuals protected themselves from COVID. Think hotels, cruises, restaurants, and bars, amongst other services. But the government didn't have to aggravate the problem by applying a version of medical central planning. Again, central planning is terrible. Socialism is garbage. Not a good thing. So we are the free people of America, and people need to learn that. Doctors, epidemiologists, and scientists can be very good at coming up with treatments, cures, and vaccines, but they're not equipped to weigh trade-offs that involve costs outside the medical arena, the loss of income, or basic freedoms. Yeah, these people are not risk analysts, and in my experience with some of the health issues I've had over the last decade, I'm not very impressed with the medical profession at all. I mean, I have some good doctors now, but some I've had in the past are pretty terrible. Let's see here. There's clear evidence that closing schools cause a harmful loss of learning, which could affect the incomes of future workers for decades, while paying people not to work has warped the labor force. Economically, the United States ran up about $5 trillion in additional debt and boosted the M2 measure of the money supply by more than 40% during the pandemic, which caused a 40-year high in inflation. In turn, this inflation led to politicians to release hundreds of millions of barrels of oil from the Strategic Petroleum Reserve in an attempt to temporarily reduce energy prices. In other words, the U.S. enters the decades ahead with more debt, less spending power, an undereducated population, and less petroleum put aside for national defense. The U.S. has made the future riskier. Again, this is a perfect example of why the federal government is nothing but trash, and we should probably just dissolve it and just let the states run things, because these fools, all they do is steal 30% of what I make and don't really do anything useful with that money other than line their own pockets and launder it back through places like Ukraine through FTX. So that's my opinion. You can take that for what you want. In other words, I already read that part. At the same time, no one can know exactly what the near-term future looks like. Right now, the conventional wisdom is that the U.S. faces a recession. Normally, we would disagree with that conventional wisdom, but this time we agree. Unwinding COVID policies will be painful, and it's going to get worse, folks. Most people think that a recession is coming because the Federal Reserve is lifting interest rates. Last week, the U.S. yield curve was inverted, with the 2-year Treasury bills yielding more than the 30-year notes, suggesting that long-term investors think the Fed has gone way too far. Obviously, raising interest rates has hurt the housing market, and imagining more economic damage to other sectors as these rate hikes bite seems straightforward. However, this is the first rate hiking cycle in an inflationary environment under an abundant reserve model of managing monetary policy. The Fed has held interest rates artificially low for a very long time, and at least for now, the entire yield curve is still below current inflation rates. But the real reason we expect a recession is that COVID policy severely distorted the economy. For example, from February of 2020 through September of 2022, real personal income increased just 2.6%, while real personal consumption climbed 6.6%. And this happened with fewer people working because lockdowns and overly generous unemployment benefits. We estimate that Americans have worked about 30 billion fewer hours during the past 2.5 years than would have happened if COVID had never hit. Yet federal tax receipts hit 19% of GDP in 2022, a near record high. In spite of the lockdowns, while corporate profits jumped 23% between the end of 2019 and the second quarter of this year. The U.S. borrowed from future generations and handed out pandemic benefits that more than replaced lost earnings. Then it taxed the economic activity that this borrowing created and kept small businesses closed in many states while large public companies remained open. The result is that spending, profits, and tax receipts were all artificially lifted above normal. The whole economy got distorted and is still untwisting from these distortions. It's as if the U.S. economy had a car accident and the emergency responders injected it with morphine. And as this morphine continues to wear off via rate hikes and smaller deficits, it's hard for us to imagine that these above normal trends will continue. In other words, a recession is in the cards. And with that recession, profits will likely fall. The combination of lower profits and higher interest rates create a headwind to markets and turbulence for investors. Yeah, not good stuff, folks. All righty. Then I got one last thing to share. This is actually a audio clip from the Scott Horton show. I heard this, listened to this over the weekend. His guest is David Stockman, He's an economist, really smart guy. And we're going to listen to a few minutes of this. He kind of goes through the different types of economic cycles, what we're dealing with right now. And, we'll go from there. So let's go ahead and hit play.
All right. Now, I know this is a lot, but I know you can handle it. Can you sketch for us real quick here the typical boom bust cycle? Alan Greenspan prints some money, we get some bubbles, we have a crash, we do it again, we have a housing crash instead of .coms, this and that, something like that. If 99 and 08 are sort of typical, but then tell me how different it is that you had the recession this time wasn't really because most recently was not because of raising interest rates. It was because of this forced lockdown. It was essentially this massive deflationary program that smashed a lot of bubbles and crashed a lot of prices at the start of the lockdowns anyway. But then they embarked on this massive monetary expansion to sort of fill in the black hole that they had caused there, sort of like 2009 on meth kind of thing, if I understand it right. But so can you just, like, if you were to sketch sort of how the typical business cycle works and compare it to the 2020 crash and now the boom that's now crashing, the 22 crash, like this is the fastest business cycle we've seen in a very long time, right? It's all so artificially induced, right?
Right. Yeah, you're covering a lot of important territory there, but I think you have to look at it in 3 stages. First, it's what I call your grandfather's recession. That's what I grew up with in the 60s and 70s. We had one in 1970. We had another bad one in 74, 75. There were actually 2 of them in the early 80s when Volcker was desperately attempting to rein in the double-digit inflation that, came out of the Jimmy Carter era of the 1970s. But the point is, those were kind of classic Keynesian-style recessions where excessive Fed stimulus and credit expansion caused too much, borrowing and lending and spending in the private economy. The Fed finally reached the point where it had to rein in its policies by drastically raising interest rates and reducing its injection of credit into the economy. And you got recessions that were led by housing and capital goods spending and eventually consumer spending as well. Now that was, let's call it phase 1. In phase 2, after Greenspan in the mid-90s, we got into financial bubbles. In other words, the economy globalized so much that the Fed Reserve credit expansion didn't just create a boom in the domestic economy or in housing, but it actually exported the implicit inflation to the entire world economy, and it temporarily became disguised by the fact that we imported back massive amounts of cheap goods from China and Vietnam and Mexico and so forth. So the cycle changed, and what came out of it was a massive inflation of financial assets because the goods and services inflation was being suppressed and diverted into global trade. But those financial bubbles, first the .com in 2000, and then the housing finance bubble. It wasn't so much we overbuilt housing; it's that we overvalued it from all the subprime mortgages and the rest of it. But that was 2008. So we got 2 pretty, one moderate recession and one pretty severe one at the beginning of this century that were driven by collapsing financial bubbles that eventually spilled over into the real economy, and you went back through the ringer again. Now, phase 3 happened in 2000, basically when Washington panicked, and I insist on blaming Trump for this. He had the control dial, so to speak, and if he had stood up to Fauci and the rest of these scientific fakers, we never would have gone into 2 weeks, to flatten the curve, but he didn't have enough understanding of what constitutional government is about, what liberty requires, and what the scientific facts actually were, which were known even then. There were a lot of experts who were warning against this. We dove into these lockdowns sweeping across the board, nothing like we'd ever seen in peacetime. And by the second quarter, you had a collapse of economic activity that was really startling, and we're still digging out from under. But there are 2 numbers that I think people ought to keep in mind. One is that at an annualized rate, the GDP in second quarter of 2020 shrank by 30%. I mean, just an astounding number. Normally, in a bottom of the recession quarter, you might get a shrinkage of 3% or 4% or 5%, but not 30. That tells you how severe and how shocking and sudden this was. Another statistic that I use is if you look at and this is something I use a lot when I analyze the labor market, which, I think the Fed and Wall Street are totally wrong about. It's not that strong at all. But I look at hours worked, not at head counts, but at hours worked. And the BLS actually does provide indexes by industry for hours worked. And when you look at the leisure and hospitality sector, which was ground zero of the lockdowns, restaurants, bars, entertainment venues, movies, sports arenas, etc., the number of hours worked in April 2020 collapsed by 56%. Just startling. That was like 40 or 50 years worth of employment growth in the leisure and hospitality, domestic, services sector, disappeared on a dime, suddenly, almost without warning, in April 2020. And that's what triggered the next round of recession. But here's the thing to circle back to your question, and that is this was clearly a supply side contraction, utterly different, the opposite of the old phase one kind of Keynesian recession. And the answer to it was for what I call the virus patrol, that is the health authorities.
All right, we'll go ahead and stop that there. Like I said, it's a really good interview that Scott had with Mr. Stockman. Again, he covers a lot of areas of the economy and what's going on now, why it's happening. And so if you have some time, the episode is linked in the show notes. It's the last one on the list. And like I said, it's a good listen. It's about an hour. I had the speed at 1.5 speed. So if you listen to these things fast, you probably knock it out in about 40 minutes. I listen to podcasts all day long. So, whether or not I'm sitting here at my desk or if I'm up and about doing chores, making dinner, I'm always listening to something, so that that's how I stay in tune with what's going on in the world. So, all right. Well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information's there. And don't know if I'll be doing videos the rest of the week. It is a holiday week, so I might check in a couple times this week, but definitely not on Thursday. That is, we're not having a turkey. We're having a ham here in our house. The wife doesn't like turkey, and it's just two of us, so we're having a honey baked ham. So, anyways, I hope everyone has a fantastic holiday this week. Spend some time with friends and family. And like I said, if you need anything from me, please reach out. You know how to reach me. And talk to you next time. Bye-bye.